Welcome to the ForeclosureDeals.com video guide on a bank's role in the foreclosure process. This video is meant to explain bank foreclosures, how homeowners arrive at foreclosure, and how to deal with banks when in a foreclosure situation. We'll also explain the opportunities which exist for investors, what information they need to know, and where to find it. Most homes and properties are obtained by borrowing money from a lending institution due to high purchase prices. Once the loan is secured, the bank holds the deed to the property as collateral against payment in full. Should the property owner fail to make payments, the bank can retrieve full ownership of the property through the foreclosure process, which requires going through a court of law. There are various reasons why a property owner reaches a point where they can no longer make payments on a mortgage. 1. The loan was based on an adjustable interest rate and payments increase as interest rates increase. 2. The property owner acquires excessive debt and no longer has sufficient income to make payments on all debts. 3. Unexpected medical emergencies, illness, or a death in the family creates financial distress for the property owner. 4. The property owner could also experience sudden job loss, a reduction in work hours or pay, or an unexpected promotion denial. 5. A divorce could take place, causing the loss of a primary or secondary income. Or 6. Unexpected major home repairs could arise. For example, the home could be found to have extensive termite damage and requires major structural repair. If the property owner defaults on mortgage payments due to one or more of these reasons, or for any reason, the bank can begin the foreclosure process. This can occur even if the property owner is delinquent by only one payment. However, most mortgage companies will provide numerous warnings before actually filing a foreclosure with a court of law. The first official warning is the issuance of a notice to accelerate. This normally occurs once payments are 60 days or more past due. This notice will contain a set date for the situation to be rectified, and nothing short of bringing payments up to date or negotiating with the bank will suffice at this point. The bank may also issue follow-up letters and phone calls threatening to actually foreclose on the property if payments aren't made. If payments aren't made by the date contained within the notice to accelerate, the lending institution will hire an attorney who will send the property owner a demand letter. This legal letter will state that the amount in arrears will need to be paid by a set date, or formal foreclosure proceedings will be implemented via a foreclosure request to the court. The demand letter is the last warning given by the bank before official foreclosure proceedings are initiated. If there is no response to the demand letter by the set date, a notice of default will be issued stating that a notice of foreclosure has been issued with the court. In most cases, the property owner will have between 20 and 30 days to respond directly to the court on why payments cannot be made. A response to a notice of default is the absolute last chance that a property owner has to avoid foreclosure. If there is no response to the notice of default before the 20 or 30-day deadline, the court will issue the property owner a notice of sale. The court-issued notice of sale usually occurs when the account has been delinquent for 3 or more months and the property owner has refused to address any of the given opportunities to prove financial distress or negotiate other means of payment. The notice of sale contains the date whereby the property will be sold at a sheriff's auction. At this point, the property owner forfeits all rights to the property and full ownership of the property reverts back to the bank. To avoid foreclosures throughout this process, open communication with the lending institution is essential. This communication should take place as early as possible within the foreclosure process, even to the point of contacting the bank before the first payment is late if a known delay is imminent. Most mortgage holders will work with and provide options to homeowners who make an effort and can show why payments need to be delayed or even missed for a period of time. There are important reasons why lenders do not want to foreclose on properties. The first reason is that once foreclosures are approved by the court, the foreclosed properties revert to being fully owned by the banks and become bank-owned properties, or real estate-owned properties, REOs. This makes the banks responsible for any repairs and upkeep necessary until the properties are again sold. In a sluggish housing market, bank-owned properties can sit for months before being resold, therefore requiring a great deal of expense in upkeep. A second reason for banks not wanting to foreclose is that they are required to set aside amounts of money to cover REOs. These amounts can be anywhere from 2 to 6 times the appraised value of the properties. These reserve amounts cannot be loaned out and therefore can tie up a significant amount of cash within banking institutions. Also, banks can accumulate too many defaulted loans and/or foreclosed homes. Banks are required to release quarterly statements to shareholders who could become displeased if this were to occur. Since shareholders are a driving force behind a bank's success, the bank wants to keep its shareholders happy by producing positive quarterly statements which are not overly vexed by a large number of foreclosed properties. If a homeowner is in jeopardy of foreclosure due to financial distress, there are numerous options to which the bank may be willing to agree in order for the property owner to avoid foreclosure. 1. The property owner can negotiate a repayment plan, which is called forbearance. 2. The bank may also be willing to negotiate a decrease in or a complete freeze of the loan's interest rate, which is known as a note modification. 3. If the homeowner has sufficient equity built into the home, they can ask the bank to refinance the loan balance. The bank will increase the amount of the loan, thereby extending the time to repay the loan and lowering its monthly payments. 4. If the homeowner qualifies, a government loan called a partial claim can be obtained to repay missed payments. 5. If the homeowner is experiencing a great deal of financial distress, they may receive debt forgiveness from the bank, whereby the bank agrees to write off the entire debt, although this rarely happens. If negotiations with the lending institution are unsuccessful and the property owner does not qualify for government assistance, they may have to resort to more drastic measures to avoid foreclosure. 1. If a homeowner is convinced that further payments cannot be made, they might consider selling the home in order to pay off the debt. 2. If the homeowner has no equity in the property, owes more than the property is worth, they might consider a short sale. If the homeowner can present a solid case to the bank that they are under financial distress and cannot make further payments on the mortgage, the bank may agree to buy back the property for less than its worth. Although both of these options may leave the property owner without a profit, they will also help the property owner avoid credit damage caused by foreclosure. 3. The homeowner might choose to file bankruptcy, which will eliminate their debt, but this will also do severe damage to their credit. Investors will find that foreclosed homes can be lucrative investment opportunities. Foreclosed homes can often be obtained at below appraised values and resold, either on the retail market or at wholesale to rehabbers or landlords for a substantial profit. Some banks are required to write off a set amount of losses each month and will often sell foreclosures cheap in order to meet their write-off goals. Investors can also seek out distressed homeowners and offer to negotiate short sales with their mortgage companies on the homeowner's behalf. Many times, homeowners are somewhere along the process of foreclosure, but they don't necessarily have to be in foreclosure to negotiate a short sale. Sometimes the homeowner can only be one payment in arrears, or simply be in the beginning stages of financial distress where they can no longer make mortgage payments. Investors can also check bank and government foreclosure listings for properties offered at reduced amounts. By taking advantage of these and other opportunities, investors can negotiate great deals on foreclosed properties. In order to make profitable deals on distressed and foreclosure properties, it is critical that the investor understand the different types of foreclosures, such as pre-foreclosures, foreclosures, and real estate owned or REO properties. They should also understand the laws which govern foreclosure purchases and sales, which can vary from state to state. Distressed homeowners and investors alike can find a trusted and thorough source of information concerning bank foreclosures, property types, and the laws pertaining to them in each state at foreclosuredeals.com. A bountiful source of bank and government foreclosure listings countrywide can also be found here. This concludes the foreclosuredeals.com video guide on a bank's role in the foreclosure process. To receive the latest news on the real estate industry, follow us on Twitter, LinkedIn, or Facebook. You can also follow our RSS feed. If you would like to know more about a bank's role in the foreclosure process, or foreclosures in general, visit foreclosuredeals.com. If it's not a deal, we won't list it here.